Okay, I think there's a big problem brewing. So a lot of time I get inquiries saying what prompted them to reach out was perhaps their pension or investment went down. And it's sort of like people expect me to go, oh no, you're in the wrong thing, and stamp my feet around. And while, look, there can often be circumstances where I've looked into the position and I go, okay, here's the problem, and you are definitely not in the right thing. And because of that, we're less certain this is going to recover. I do really worry that there might be a lot of advisors out there that sometimes pander to that panic and approach and might even just switch things around instead of just telling the truth. And most importantly, it perhaps is that feeling that somewhere in the last 10 years, our expectations with investments have changed. So in this video, I'm going to give you 5 steps for assessing what to do when your investments are down. So, point 1, check if it was your mistake. AKA, did you put all your eggs in one basket? There's a fundamental difference between proper evidence-based investing and speculating. It is completely normal to get wiped out and lose all your money in an investment which is over-concentrated. Here is a list of companies which seemed like household names at the time had you invested them, but now you would be left with absolutely nothing. The reason why diversification is considered the only free lunch in investing is because without that, specific risk can eat your lunch. So if you had diversified properly for over 200 years of market history, the stock market has always recovered. Yes, we can have periods which are very painful, and it is normal to have these periods which are painful, but this is what it takes, and this is the trade-off to get the long-term return. The problem with concentration in general is that the research on this shows that single stock investments, if you invest in one company, they're really heavily skewed. I've mentioned this before, but there was a paper from a guy called Henrik Bessenbinder where he looked at the returns of thousands of single stocks. So we've got the return at the bottom, losing money on the left, doing nothing in the middle, and making a fortune on the right. And here is the distribution. So what you might be thinking, what on earth does that mean? Well, individual stocks are a bit like lottery tickets. Some big winners and lots of losers. So if you invest into the broader market, you get the average, which is great because it's enough to push everything forward.
Visualize investment as growing in kind of a steady line, which it does, and visualize the crazy market as being all these jags up and down around this steady line, upward, always upward, I think. Then you've got to say, I know I'm not smart enough to get out at the high. I know I'm not smart enough to get back in at the low. So I'm just going to stay the course.
If you don't, then absolutely, you might pick the winner, but you might also go nowhere for a very long period of time. So I'm really sorry to tell you this, but if your investments have tanked because you took an over-concentrated position in an investment, it was your fault. And the same sentiment for what I'm going to say on the next few points may not apply. Okay, point 2. Acknowledge that your investments haven't lost money, but you're about to. All right, okay, so there's a guy called Nick Murray, he's kind of like the advisor's advisor, and he's quoted to say, permanent loss in a well-diversified portfolio is always a human achievement of which the market itself is incapable. And what he means by this is that if you had invested in a well-diversified way, we are yet to have a point where the market has lost money. So if you come up and say, look, my investments have lost money, my counter to this would be, well, have they? Or are you about to? Because if you have set them up right, then it seems that the biggest risk to your investment is you. You're wanting to take action and change. And I know it's straight talking, but it's the truth. So number 3, remind yourself that you own the same thing. We live in a world where we're given information, but often that doesn't help the long-term aims, and gives us temptation to act upon things. Perhaps it's like going to the gym and, trying to achieve your body goals and having to walk past McDonald's on the way there. Or trying to quit drinking, but getting asked to go to the pub on Friday by your mates. It's that challenge that we have that we've got to try and push against if we want to be financially secure in the long term, about being worried about the short-term temptation. So let's frame this. Imagine there's a frantic house buyer traveling from house to house, knocking on all the doors saying that they want to buy your house and your neighbour's house. They do this all the time, it's a bit weird. But anyway, for the past few months, they have visited your house and they've said it's worth 20% less. Do you feel moved to sell it? Well, the truth is you'd probably rationalize this and say, no thanks, I still own the same thing, I'll wait it out. And if you're invested in the long term as you should be, it should be as simple as that. Just remember, just because the fact that your investment values are available to sell on an app doesn't mean that you should act upon it. Think about the house buyer. The offer doesn't mean the sale or the value. All right, number 4, remember why you are investing. So why are you investing? What is your plan? What's your investment plan for? Perhaps it's for just a general, your financial future, having the freedom to maybe work part-time in a couple of decades, help your kids out, retire, whatever it might be. For me, I'm investing for a better future, but that's literally 20 years away. Maybe even more. Think about it. I'll be in my futuristic house or my robot mace and probably still being really boring and talking about pensions, but that's a sidebar. But if we zoom out and we imagine our lives and what we're trying to invest for, we can create some perspective which can help frame our short-term decisions. It's sort of like the problems that you think about that you had last month. Chances are they feel quite insignificant now, because the majority of problems on a day-to-day basis aren't kind of long-term, life-changing things. And one thing I can promise you is that there is always something. The key thing is just to think, this too shall pass. And finally, understand this is totally normal. Investments are byproducts of human nature and life. There are some good times and there's some bad. How you act on it will define you and your results. But just for some context, since 1926 for the UK market, the average bull market, that's where the market went up, lasted 7 years and provided a positive move forward of 508%. So the average bear market, which is typically defined as a market which drops 20% or more, lasted for 1 year and 6 months and had a depth of 35%. So that in itself, I would like to hope, is heartening, as the odds are clearly in your favour of the forward march, which is always the case. Though averages do paint a slightly inaccurate picture, because the longest bear market was in 1937, lasting 3 years and 7 months, but the most savage was in 1972, being a 67% peak to trough decline. Now that is really very painful, and the reason to keep yourself globally diversified. There's also the intra-year decline, which I'm going to show you now, which is basically just to say that, look, it's very common for the drop in the middle of the year to feel quite painful. So what I'm saying is, let's be real, bad times can happen. You really need to see it as a test, because if not, it might not be your investments that lose money. It'll probably be you. So if you like this and you'd like to keep in touch on these videos or some debatably finance related stuff, such as articles on star fund managers, finding a life with purpose, or sometimes even really random stuff about the stock market, why not subscribe to my mailing list and link below. See you next time.